Anyone make any money this week? Good afternoon, everyone. Has everyone had a very nice week? So it looks like we're starting to get this little crash out of the way. We've made some good returns and we've got some of our money back. Now we need to start looking long term. In December last year, I learned that I could make a few different choices with my money. I've grown up relatively working class. I mean, not that bad, but my dad had a hard time in the 80s with going on strike and rising interest rates. And because of all that fear, he developed a relationship with money which was very much earn and hoard. That money mentality was passed on to me. I spent most of my 20s with whatever little amounts of savings that I had stuffed in low interest savings accounts, just sitting there ready for me to spend it on something. I knew nothing about investing. I just figured that investing was for people with very large sums of money. They needed to have a tip off from a mate inside a company, and then they would dump that money in and make millions off it when it came through. I had absolutely no idea how money worked, and that was generally down to a lack of education sources. But 20 years on, we've got a bit more going on, a bit more technology, lots of commission-free trading apps, and access to information that has made me realise that investing just isn't that fucking hard. When I say it's not hard, I don't mean stock picking and stuff like that, that's pretty hard, but my barrier was way before that. I didn't know I could open an account with a brokerage. I didn't know I could put money into an index fund. And I didn't know I could pay into one regularly and have it grow my money over time. And while this type of investing isn't risk-free, it's relatively low risk, and I'm likely to see considerably higher returns than if I just had it rotting in an ISA account. I've definitely written off the idea that I'm going to make $1 million off one cash deposit. It certainly still happens, but I for sure am a long way off opening that level. Lots of us are making great money in short-term gains right now. I've even done it myself with Facebook and AstraZeneca and Apple and Beyond Meat. And when I do make this little bit of money, a couple of £100 here and there, I start to think, fucking hell, maybe I'm pretty good at this short-term thing. Maybe I should trust my own judgment more, put a bit more faith in myself. And that's the problem with these short-term successes. They instill a little bit too much confidence into me. I start taking bigger risks with more money, more frequently. When really, when I think about it, all those previous wins were probably just luck. If you held money in the S&P 500 last week, you would have seen returns that would usually take 4 years to achieve. I'm kind of proof that you could have just popped your money in anywhere between March and June, and you would have seen returns of about 30%. We're just in that kind of market right now. I really wish I had had a big lump sum of money just to dump in March, but I didn't. I had to wait for my ISA to open. And in truth, I don't have a large lump sum of money that I could have just boshed in. I really have to think about the long term because I don't have a lump sum of money that I can just go and bosh in Microsoft at the start of March and have it raise 40% in a few days. I have to be very clear that my portfolio is not going to be showing 30%, 40% anytime soon. It's not my goal, and I'm very, very risk averse in comparison to, say, the rock stars who are making money off like Cineworld and Tesla and ITM. My strategy is to find very boring and very safe companies to buy into. I'm just trying to make life easier for my dumbass by looking at blue chip companies with dividends, not necessarily because they pay high dividends, but because dividend paying companies are likely to fit that description better of being boring and safe. Like one of my favourites right now, which is Medtronic. Medtronic's having a brilliant day today, but it's still a little bit underloved. It's a great company that sells a lot of different medical products. Its PE ratio is a little bit too high, I'll admit, but that still hasn't put me off. Its payout ratio is between 45 and 60%, and another great part about this company is its current ratio. If a company is just covering its short-term liabilities, then it's said to have a current ratio of 1. Anything over that means that the company has more cash to hand than it's giving away. So if a company has more cash available to them and less costs weighing them down, then they're in a safer position. Definitely a plus during economic uncertainty. One thing that does worry me about Medtronic is that it's got a lot of loans coming up. However, once this coronavirus thing is over, it's projecting that it's going to have a great next 5 years. This is because it owns about 60% of the diabetes market with this great little machine that tests your glucose automatically. It's pretty much the only one out there. And if you're going to be having a heart attack anytime soon, then it's very likely that the NHS will be fixing you with a Medtronic product. I love the grasp that Medtronic has on the market, but I also like to see that it is investing in new things. Innovation is really important to me, so I do like to see when these boring blue chip companies are pushing the boundaries and trying to figure out what the next step is. And Medtronic have been investing heavily in remote surgery and even AI surgery, which appears to be the direction that modern medicine is going. So to me, Medtronic is a little bit unloved, and yesterday it was 4% down from where it currently is, so I was going to average into that 4%, but now we're just 1% in, so let's buy a couple of Medtronic. We go to buy, click into 158 quid, review order, send buy order. And there we go, we've got 2 Medtronic at 100. A little bit higher than I wanted, but long term I hope to see a good rise with these guys. Ultimately it would be lovely if I could beat the market. It doesn't look like I'm doing that right now. But in all honesty, I would just be happy if my money grew a little bit more than if it was in a savings account. I think the best liquid savings account right now is 1.4% in premium bonds. And just to put that into perspective, inflation on a normal day is usually 2%. That means if you have your money in the best liquid savings account in the UK right now, your money will be becoming 0.6% less valuable every year. So really, I've just got to beat that. And my aim is to make this modest amount of growth by investing in strong dividend companies over the long term using the cost averaging strategy. Okay, get ready because it gets a little bit heavier here. To understand the benefits of the cost averaging strategy, we need to understand that the market and the economy don't always just go up. In the long term, that's where they go. And this is called productivity growth. In the short term, we have small crashes in the middle, and in the long term, about every decade, we have some large debt crashes. The large debt crashes are periods in time where Joe Public can't pay for things. This is because there's no jobs or banks aren't willing to lend Joe money because they don't think he can pay it off. This usually sends the stock markets down because investors are scared that businesses won't do as well as normal, or investors themselves just don't have the spare money to put into the market. This is very relevant now because we're seeing a market that's disconnected from the economy. The market is heading up very quickly, but data is showing that Joe doesn't have a job and he's not going to be able to buy anything. So even though the market's going up right now, there's a lot of us that are scared that something big's coming. It's even way too high for me now. I was looking at more of a square root recovery where we were going to see a good rally and then we would start to just see a nice trail upwards. But if that market makes it all the way to the top, we could be seeing a W. And I think I've found my first proper narrative for this right now. The UK has had a growing car lease market for years, and there was a little bit of a bubble growing before the crash. Everything's been so good recently. We've been allowing people to lease more and more expensive cars, even though they might not have been able to afford them. And now Joe Public might not have a job. He could be getting his car taken off him pretty soon. This is very similar to how the 2008 financial crisis happened. It's not on the same scale, but it does follow the same principle. And America has been doing it too. It's been allowing Americans with very poor credit ratings to buy used cars. And already lots of those loans are defaulting. If this continues, analysts are predicting that there will be a second crash, and a real one this time, somewhere towards the end of the year and early next year. I feel that this story is very important because it's much more of a proper story. You can show me all of the global liquidity graphs that you want. I'm not going to understand it until there's a narrative playing out, which I think we're starting to see. Sorry, I didn't want this to become another crash video, but I thought that was important. We'll carry on. So this process of grow, crash, grow higher, crash higher, grow even higher, that's been going on since time began. We only started measuring it in the 1900s. And this is likely to continue until everything comes crashing down. But until then, the market is going to continue going through these short and long-term debt cycles. And when we get one of these big recessions, that's when the cost averaging strategy comes into its own. Let's imagine we're back in 1929, when alcohol was banned and colour hadn't been invented yet. The Dow Jones is roaring, but you've been very smart and you've hoarded 500 shillings inside your chamber pot. The stock market crashes and you're looking to get your money in right at the bottom. And I'm guessing this would be the place that you need to get in, right? Right before the recovery. But what we didn't realise, this was a false recovery and it got a lot worse. And that's the problem with trying to drop lump sums into the market. You just don't know where the bottom is. Cost averaging is the practice of spreading your investments over long periods of time. So when there is a recession, you're at least giving some of your investments the best chance of benefiting from the downturn. It mainly detaches you from all that emotional decision making and prevents you from putting all your money in at the worst possible spot. If you've just earned 100k in a lump sum right now, first I'd suggest you keep doing whatever you're doing to earn that 100k, because that's the quickest way you're going to become a millionaire. But if you've happened across a big lump sum of money, like your long lost uncle's died or something, then it's probably an idea just to pick an index fund and dump it anywhere on the line right now. Because it's very simple. If you put all of your money in down here and the market ends up here and you take out, you've achieved the best thing that your money can possibly do. But I don't have 100k lying around. If I did, I certainly wouldn't be here talking to a camera. Maybe I would. I really love working an extra 15 hours a week just so someone can rip the shit out of me on Discord. But yeah, I don't have a lump sum lying around, so cost averaging is the way to go. It's much better than saving up little lump sums and then waiting for the best point in the market to drop in. Many of you will have already seen the example of the 3 girls. As the story goes, there's these 3 hypothetical girls that all start investing at the same time in 1979. 2 of the girls decided that they wanted to get in at the best time, and they saved 200 quid a month until the bottom of a crash, and then they put their money in. Tiffany was shit. She dumped her 4 lump sums in at the top of the markets right before they crashed. This is the worst timing in history, but she never sold and she made about 600k over 40 years. Brittany was perfect. She put all her money in at the bottom of every crash. She also never sold and came out with nearly $1 million. But slow and steady Sarah didn't save up these lump sums. She just kept on putting £200 a month into the market and she never looked at it again. She came out with around 1.3 million. Really, this story isn't about cost averaging. It's about having your money in for the longest amount of time and not selling. Really, if cunty Karen had her £100,000 sum and she put that in right at the start, she would have a lot more than any of the slow and steady Sarahs or anything like that, because she simply had her money in for a lot longer. The difference is Sarah is just saving, whereas Karen will see her entire lump sum cut in half as soon as the market crashes, and that can make people tetchy. So cost averaging, if you have that lump sum, is really just a tool to keep your nerves. But if you don't have that lump sum, it's much better to just keep trickling your money in rather than saving up big lump sums ready to time the market. Because you don't know when the bottom of that market is. But you could get pretty close, right? You could get within maybe a week or 2 of it. But between 1999 and 2018, if you missed out on the top 10 best days of returns, you would miss out on a significant portion of market gain. And the only way to guarantee you won't miss it is to consistently feed in some money. The absolute worst idea right now is to keep your money sitting in a savings account, because as we know, it's losing at least 0.6 in value a year, and if you're attempting to time the market, you're limiting your returns to somewhere between Tiffany and Brittany, whereas if you're cost averaging in, you're getting a bit closer to Sarah. But none of this works if the market doesn't get started again. There are still a couple of reasons why this might not work. For instance, if you're picking companies like I am, one of those companies can go bust, and that'll seriously damage your return. Index funds and ETFs are definitely safer for that reason. But more worryingly, the economic markets could trade sideways for the rest of my life. And one of my ideas to maybe combat that is to stick money in dividend yielding companies. So I feel like I'm kind of hedging everything there. I feel like I'm in a bit of a win-win. I'm sure there's some maths out there that says dividends are irrelevant. That's okay. I can live with that. Okay everybody, I need your help. I've got an idea for this new segment that I want to get people involved in. A hell of a lot of people have been asking me to review stocks. I can do that, but it'll take a lot of time to get around to every single one. So what I'm thinking is maybe developing a quick fire segment. So if you for some reason would like my opinion on a stock, I don't know why you would, feel free to let me know what it is in the comments below. I'll promise I'll do an hour or so of looking at it, and I'll do my best to sum it up in a couple of lines. It sounds fun to me. If you would like to sign up to Trading 212, there is a link in the description below. If you click that link and sign up, you get a free share and one of my subscribers gets a free share as well. Thank you very much for watching everyone. If you enjoyed this video, please give it a like and subscribe. And until next time, keep cost fucking averaging.